Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, an equity strategist for ADCB. With an objective to empower you with investment insights, on this program we discuss various perspectives shaping the global investment landscape. In a series of podcasts, starting with this one, we would be discussing our 2022 investment strategy outlook. This week, we start by thinking about the broader macroeconomic point of view. If you asked us, what is that one macroeconomic aspect that we would be monitoring over the course of the next 12 months, we would, without hesitation, say that it is the evolution of the growth inflation mix of the global economy and across countries. At least over the first half of 2022, the tug of war between the slowing growth and higher inflation is likely to influence the policy and the direction of the financial markets. On the economic growth front, we have a good news and a bad news. The good news is that in absence of any exogenous shock, the chance of a global recession during 2022 is relatively low. The bad news is that growth rates across the board are likely to moderate over the next few quarters from very strong growth rates of the past few quarters. Of course, this moderation will still leave the growth rates at strong levels and in many countries above their potential. Also, as we pointed out in our podcasts in the past, in aggregate, the global economy is moving from the early cycle phase into a mid-cycle environment, and arguably, the cycle is moving much faster than normal. However, market participants who believe that most major global economies would rebound from the slump in a lockstep have been disappointed in 2021. This asynchronous journey is likely to continue into 2022. The mid-cycle transition of this faster-moving asynchronous cycle creates opportunities and risks for investors over the next year. Such transitions are usually associated with higher uncertainty and financial market volatility. As the cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. Thinking about inflation, thus far this cycle it has proved more persistent than initially expected, thanks to lasting supply-side bottlenecks. There are reasons to expect that inflation rates, which measure a year-over-year change in consumer prices, will moderate in Q1 of 2022. Yet, the glide path of inflation, especially relative to growth, will be the key trend to watch. The risk here is that inflation could stay elevated for longer than expected, creating a negative growth inflation mix. Speaking of risks, alongside persistent inflation, there are many facing the global economy in 2022. These include sharper slowdown in economic momentum, new variants of the COVID-19 virus that escape vaccine efficacy, higher than expected fade in fiscal stimulus, increased tech regulation in the US, escalation in US-China trade tensions, higher corporate and personal income taxes in major developed markets, risks around political events like the US midterms, 20th Congress of the Chinese Communist Party, presidential elections in France and South Korea, chief executive election in Hong Kong, and general elections in Brazil. Also, geopolitical risks in certain geographies are worth monitoring too. However, in our view, the biggest risk is a potential policy mistake by the central banks. Here, if the policy tightening helps improve the growth-inflation trade-off, it is likely to be appreciated by financial markets. However, should the policy tighten too much, causing a further slowdown in growth, financial markets could experience quite a bit of turbulence. In summary, our base case scenario for 2022 assumes a faster moving global economy transitioning into a mid-cycle environment. Such transitioning is likely to be asynchronous across the constituents. Inflation is likely to start moderating in Q1, and central bank policy will be appropriate for the growth inflation mix. The downside risk scenario, which still has lower probability in our assessment, sees an unfavorable growth inflation blend and an inappropriate central bank policy. Over the next few weeks on this podcast, we would be discussing how this macro environment is likely to influence asset class performances. Watch this space. Thank you for listening. In case you would like to get more information on what was discussed on this podcast, please reach out to your contact at ADCB. You can also log on to our website www.adcbam.com for more information. And do stay tuned for more episodes of this podcast discussing our 2022 outlook for various asset classes. Thank you once again, and this is Kishore Muktinutalapati signing off.